It's not about how much you make, it is about how much you take home. So in today's episode, we will be sharing an end of financial year checklist so that you can maximize your return. Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode, although I must say, not as excited as you, because there are times in your life that you get up and about for, and one of them is tax time. Back in the day, you would crack out your little spreadsheets, be looking up this, index match that, how much can I deduct here? These days, it's all done for you online. You're a big fan of Sharesight, but you still get so excited.
Well, as I said in the intro, it's not about how much it's not about how much you make, it's about how much you take home. But look, we're going to do a two-part series on tax, given we have just closed out the tax year for 2025. And this series is brought to you by Sharesight. Sharesight is a tracking platform that, as you mentioned, Ren, I use in my day-to-day to not only track all of my investments, but also to track and be prepared at tax time. Their tax reporting makes it super simple.
Yeah, so in this episode, we are going to step through our 7-step end of financial year tax checklist, and we're going to be joined by Peter Nevill from Viola Private Wealth. We aren't the tax experts, but Peter and the team at Viola Private Wealth help their clients maximize their tax returns at tax time. So he's going to help us understand how they approach it. And then in the second episode, we're going to go beyond 30 June. We're going to go beyond the end of financial year and talk to Peter about the all-year strategies they use at Viola Private Wealth to minimize the tax their clients pay. So get the pen and paper out, because I think we are going to be learning a lot.
All right, well, let's get stuck in. We've got 7 steps. Step number 1, know what you've made, know what you've lost, and that is by reviewing your capital gains and capital losses.
Yeah, we start off simple on this checklist. Yeah. So for people who are new to Equity Mates and new to investing, if you invest and you buy shares and you make money on those shares, that's a capital gain. If you lose money on those shares, it's a capital loss. Obviously, the gains are taxed. The losses you can actually claim a tax credit for. So it's important to track the losses as well as the gains. Bryce has a massive backlog of capital losses that one day he hopes to claim.
No, not true.
So I guess the action here is simple. Go through your portfolio and identify any realized capital gains or losses, so that what you've bought and sold, and any unrealized capital gains or losses as well, ones that you still are holding, but you've either made money or lost money on. And the unrealized gains or losses will become important as we go through this checklist. But step 1's simple. Know what you own and what you've made or lost. The great news is if you have Sharesight, they do the work for you.
That's true. I was going to say that is only, you're not going to be able to do that if you don't have a good record of when you've bought.
Tax time sucks if you're not keeping records.
Definitely.
Yeah.
Definitely.
That's why I don't sell, because it's then you don't have to deal with tax reporting.
That was your strategy at one point. Yeah. I'm not going to clean up my portfolio because I don't want to deal with it. Sharesight, baby.
And then often I'll be like, all right, this is the year I'm just going to, when I did my big portfolio shift and rebuilt my core from scratch, I was like, I'm going to do it all in one tax year, and it's going to be a really painful tax year, and then I'm not going to adjust it. Luckily, Sharesight makes it a lot easier these days.
That's right. All right. Checklist number 2 is to harvest any tax losses. Now, this is applicable. You need to do this before the end of the financial year. But what it is, it's selling investments at a loss to offset the capital gains that we just spoke about. So it's reviewing your portfolio and having a look at any of those dog stocks that you want to get rid of that are down and out. Sell them off so then you can use that loss against any capital gains.
So let's give a really practical example. Let's say you made $5,000 on Fortescue shares. Probably didn't in the last 12 months, but let's say you made a $5,000 profit on Fortescue shares, but separately in your portfolio, you've lost $5,000 on Redbubble. You could say, all right, well, if I don't sell Redbubble, I'll have to pay tax on the Fortescue gains, or I can sell that Redbubble at a loss and then offset my gains with the loss.
Yeah.
So then I minimize the tax I'm paying.
Yes. There's one thing to watch out for, which is a wash sale. And a wash sale is where you can be accused of selling the asset just before tax time and then rebuying it immediately after in the new tax year to take advantage of that.
I mean, a wash sale would come at any time of year. It's if you sell it and then you buy it back immediately to claim the tax loss.
True.
Yeah.
Yeah.
And so don't do that. Only sell the dogs in your portfolio that you believe are dogs and that you're not going to want to buy back in next week.
Yeah.
So that's the action. Look at your portfolio, look at those unrealized losses, see if there's anything that you're happy to sell to offset any capital gains that you've made. And if you do realize capital losses, make sure you claim them in that tax year, because if you don't claim them in that year, you don't get to claim them down the road. So even if you don't have any gains to offset in the current tax year that you're filing for, still file the losses there because they just bank up, much like Bryce has banked up over the years.
Mate, I've so many capital gains that I need to try and don't worry. All right, let's keep moving. Item number 3 is to review your dividends and claim your franking credits. Now, franking credits help you avoid double taxation. And by that, we mean a company, when they pay you dividends, they've already paid tax on that income or that profit. So then the ATO doesn't want to double tax by making you pay tax on the dividend as well.
Yeah, Australia is one of only 3 countries in the world that have full dividend imputation. So you can thank our policymakers for that. To give you a practical example of how it works, let's say you own Commonwealth Bank shares and they pay a 30% corporate tax rate on their profits. And then after they pay that tax, they then pay that profit out to their shareholders. So if you as a shareholder get a fully franked dividend, and let's say you're on a 37% marginal tax rate, then you're claiming the franking credit for the 30% tax already paid.
Yep.
And then you'll just be taxed the difference to true it up to your marginal tax rate. It's something that's quite unique in Australia, and it can save people a lot of money, especially as their portfolios grow over time, because Australian companies love paying dividends. So it's important that you claim your franking credits. And would you believe it, Bryce? Sharesight make it easy.
They do make it easy. I was just thinking back in the day how annoying this was. You used to get a paper form telling you every time your company paid a dividend, and it would say how much of the dividend was franked, and you would have to take that to your tax accountant, and they'd have to go through all the dividends paid. Super annoying, but luckily Sharesight does do all of that for you.
Now, the action on this step isn't just about franking credits. It's about dividends more generally, because here's something where new investors often go wrong. The idea of dividend reinvestment plans is great. And I love dividend reinvestment because you don't have to think about adding more money to your investments over time. But the ATO, whether you reinvest that dividend or whether you take that dividend as cash, the ATO sees it as you being paid that dividend and they're going to tax you on it. So even if you have a dividend reinvestment plan, make sure you're still adding those dividends to your assessable income at tax time.
Yeah, easy. All right, well...
Easy with Sharesight.
With Sharesight, yeah. If you want to check out Sharesight, head to sharesight.com.au/equitymates and you can save 4 months on an annual subscription. Highly recommend.
Yeah. Okay, we are 3 steps down. We've covered the easy stuff.
We have.
Know your capital gains and losses. Think about harvesting any unrealized losses and make sure you track your dividends. The next one, also simple, highly overlooked, top up your super contributions.
So each year we get a concessional contribution cap, which is up to $30,000 per year, and that is taxed at 15% versus your marginal tax rate. So for a high income earner who's on 45%, for example, if they were to contribute an extra $10,000 to their super up to that cap, it would save them, and that's pre-tax, it would save them roughly $3,000 in tax.
Yes.
Now, there's also a carry forward amount. It means if you haven't done concessional contributions year on year, you can carry forward the difference from the past 5 years. So if you do come into a windfall or a lump sum of cash, you can bring that amount forward and contribute up to that cap.
So that's one thing that everyone can think about, concessional contributions. Another tax benefit that you can think about if you have a spouse is spousal contributions. Now this one is, there's a few more terms and conditions. There's a bit more fine print that you need to understand, but you may be eligible for a tax offset of up to $540 by contributing up to $3,000 to your spouse's super account if they earn below the $40,000 threshold.
Yes.
And so like the policy purpose behind this is when one spouse takes time out of the workforce to look after elderly sick parents or raise kids or whatever it is, the working spouse can help top up their super, so the super balance gap isn't as large as we're sort of seeing at the moment.
That's it.
So that is something to look at. It's probably, for a lot of this stuff, worth speaking to an accountant to make sure you're ticking all the T's and C's when it comes to super.
That's it. Now, in terms of strategy, when it comes to this, you can generally sort of late June or in June is the month to be looking at this. If you have excess income or excess cash, you can be putting it into the concessional contribution.
Because here's something that I didn't realize until I was researching for this episode is the contributions actually have to be received by the super fund before end of financial year. There's none of this like, I sent it before the end of financial year. It has to hit their accounts. So make sure you're giving yourself enough time.
That's it. Checklist item number 5 is to claim all eligible investment deductions. This is the one that gets a lot of people excited. In principle, what this means is you can deduct expenses associated with earning assessable income.
And we're going to say it right off the top. No, brokerage is not a tax deduction.
Yes, that is correct.
We get asked that all the time.
The big one is obviously interest expenses on investment loans. So if you've taken out a loan and you've invested it into assets that produce income that go towards your assessable income, you can reduce or deduct the interest payments against your assessable income. You can also deduct the cost of financial advice that is related to producing assessable income. So you can't deduct the entire financial advice fee, only that is relevant to the investment strategy.
Yeah.
And then finally, Ren, internet subscriptions, any other costs, AFR subscriptions or the like, you can have a look at and deduct.
Yeah, as long as there is a nexus to producing assessable income. Like that's the tax principle at play here. Like the ATO is like, if this is going to generate more tax revenue for us over time, we're okay with you claiming a tax deduction. But if not, then no. No
good.
Yeah.
Yes.
To go back to the brokerage point, because people get hung up on it, the reason that is not related to a producing assessable income, because you're like, well, it's a cost incurred in investing in something that will make money. It's because it forms part of your cost base.
Yeah.
Yeah.
My Sharesight subscription, though, is tax deductible.
Well, there you go. So if that's not a sell, then go to sharesight.com/equitymates and learn more about it and get up to 4 months off a premium subscription.
So good.
Yeah. Okay, we are 5 down. We are 2 to go. This is one that I hadn't thought of before. Checklist item number 6, prepay deductible investment expenses.
Yes.
So if you have an investment loan, a margin loan, income protection insurance, you can prepay 12 months in advance to bring forward the deduction into the financial year. So if you've had a big bonus at work or you've made heaps of money on shares, you've had a good year and you're scrambling to find ways to reduce that assessable income, you're tax loss harvesting. Another thing you can do is you can prepay a bunch of deductions to bring it into the tax year that you want to reduce your assessable income, which I'd never thought of. It makes sense. I wonder, can you only do it for 12 months? Could I prepay like 10 years of Sharesight subscriptions?
Well, I don't know specifically if you could do it for Sharesight, but I know for loans and stuff you can. I don't know how long you can push it out for though.
Yeah, or could I go to like Commonwealth Bank? Like I don't have an investment property, but could I say I want to, like I've just sold Afterpay and made 100x my money. Could I pay 30 years of interest only on this loan?
Maybe. I don't know. We'd have to call one of the banks to find out.
Maybe we ask Peter Nevill that question. But look, as we were prepping, it was prepaying 12 months in advance. So I think anything beyond that, speak to an accountant.
Yes. All right. And finally, checklist item number 7 is to maximize your charitable donations. So donations over $2 to registered charities are tax deductible. But you must have a proper tax invoice to go along with the claim. I mean, this is said for everything. Any claim you make, you need to have paperwork to support it. But things like raffle tickets and those sorts of items don't count as a charitable donation.
No, anything where you get a benefit in return, even if you're giving that money to charity, and you can't say, well, I didn't win the raffle. Anything where you might get a benefit in return, no matter who you're giving the money to, doesn't count. But it's like when you are actually genuinely giving a donation.
Yeah.
Yeah.
Nice. Well, there are the 7 end of financial year checklist items to make sure that you go through and have in your back pocket throughout the year, really, because some of these you can have a think about and plan for. Others are sort of later in the year.
I mean, look, the tax is complicated. There's no doubt about that. But the principle is quite simple, really. The way it works in Australia is everything gets rolled up into your assessable income number, your capital gains, your income from investments and dividends, your salary, whatever it is. And then the name of the game is to find ways to chip away at that assessable income number and make it smaller. The capital gains discount, franking credits, or deductions from charitable donations. All you're trying to do is just chip away at that assessable income number.
Yeah.
And so this 7-step checklist is some of the ways to do it. We're going to take a quick break here, but then on the other side, we're going to be joined by Peter Nevill from Viola Private Wealth to talk about how he approaches the end of financial year with his clients.
Peter, welcome back to Equity Mates.
Thanks for having me.
So, Peter, what are some of the most common mistakes that you see people make in the lead up to the end of financial year?
Probably trying to sort of over-engineer it a little bit in terms of the gains and losses piece. So if you've got something sitting there that's in a loss position, whether it's, market sentiment's turned against it or, it's at a cyclical low point or something like that, but the investment case is still there, cutting your nose off to spite your face and selling it just to crystallize a loss can really sort of hamper your returns in the long term. So probably trying to over-engineer that gains and losses piece, but really sort of super contributions are the big one, making sure that you're getting those made.
As in, so you see people like mistime that or just miss it completely?
Either mistime that, but also there's, if you make a tax deductible contribution and don't end up completing the necessary form, which is a notice of intent to claim, that needs to be lodged with the super fund. Just needs to be lodged before you do your tax return, but it can also impact, I suppose, the contribution caps as well, that if you don't, until you lodge that, it's considered a non-concessional contribution.
So we were chatting earlier how the concessional contributions you make need to hit the super fund's account before the end of the financial year. Does that form need to be submitted before the end of the financial year as well? Or is it just before you submit your tax return?
No, it doesn't. Just before you submit your tax return or before the end of the next financial year.
Yeah, okay, nice.
But leaving the super contributions piece too late can be sort of fairly common. And a lot of super funds are pulling their hair out at that time of year, no doubt, with the influx of people trying to do this, and almost have a pre-prepared message as you call the super fund saying, if you're calling about non-concessional contributions or contribution caps, please go away.
We don't want to know about it.
Make sure you get them in with plenty of time left.
Yeah, nice. Okay, so there's some good mistakes to avoid. I guess, do you have a checklist that you work through with every client at this time of year? Just some non-negotiable things you want to just make sure and tick off?
Yeah, the super piece is the really key one. That's a vital structure for everybody in their sort of wealth accumulation and longevity. So making sure those super contributions are getting maxed and getting made. It's obviously dependent on someone's circumstances, but ensuring that's getting done. Then going through that whole tax planning piece around what's been realised in terms of gains for the financial year, and then looking at what perhaps is in a capital loss position. Again, those decisions need to be sort of made in the right context, but also making sure that you're conscious of if any capital losses have been crystallised in a previous financial year, they're available to be brought forward and offset future gains. So making sure that you're across all of that. We're very fortunate that we have sort of good systems that allow us to be sort of right across that, but that's sort of the real key tax planning piece in terms of gains and losses. And then we've got more and more clients in pension phase now, so making sure SMSF pension minimums are met for the financial year. Otherwise, SMSF can become non-compliant.
Yeah, right. Now, when it comes to deductions, everyone's favourite part of tax time, are there any that you think people often forget to do? Are there sort of key deductions that we should be thinking about?
Yeah, simplicity is sort of often the best thing. And like most that are going to affect most people would be things like investment interest. That's obviously tax deductible, work-related expenses. But the tax deductible superannuation piece is a real sort of key one in being able to sort of minimise the amount of tax you're paying. It's that beautiful sort of double advantage of growing your wealth in one of the best tax structures available and also reducing the amount of tax you're paying in the near term.
Double whammy.
Yeah. Double whammy.
Yeah.
So we spoke about tax loss harvesting a bit earlier, but we get so many questions around this time of year about should I sell? What are the criteria on like making that decision? Because it is obviously dependent on people's personal circumstances, but then it's also dependent on the thing that they've lost money on. But how would you work through that decision with a client? What should we be thinking about? Or does tax not come into it at all? And it's just like, is the thesis still intact? And that's where the decision lies.
Yeah, ultimately what we want to do is we want to invest for the outcomes and then worry about the tax later. So that's the sort of key point to make. But then if I suppose, someone like Bryce who's been 10-bagging all year.
I know.
He's been trying to 10-bag. I'm worried he's going to be down by the end of the year.
I'm going to have, my capital gain's going to be nuts.
So then obviously what you want to do is that if there's sort of something sitting in the portfolio where the investment case is broken, realising that to offset some of those gains sort of can make absolute sense. But it is really an individual sort of decision around, the investment thesis moving forward for anything. Paying tax is not the worst thing in the world. It means you've generated a return. You've got some income, you've got some capital growth. It's a good thing. We do want to minimise it though, obviously. But going through it and being sort of very conscious around each asset and, our future view on that asset, and then making sure that we're doing it at the right time. So there's no point sort of kicking that loss into the next year when it could have offset some gains this year.
You've mentioned super a number of times. Our audience is probably on the younger side compared to some of the clients that you're working with. How should we be thinking about, or how would you be talking to your younger clients about the concessional contribution? Is the philosophy like you should always be trying to max it out, or is it again case by case?
Yeah, it's certainly not a one size fits all. And it really comes down to what you're looking to achieve, especially before you can access super. So while it's the best tax rate that we really have available to invest within Australia, we can't access it till we're 60 at the earliest. So for those that are, have got sort of 20, 30 years before they're able to access it and have other goals that they want to meet, before that period of time, whether it's, they're investing to get the capital to purchase a property, for example, if you tip that money into super, we can't get it back. So while the tax, advantage is there and attractive, making those contributions when you need that capital for something else may not make sense. So really it's sort of determining in each client situation what the optimal thing to be doing is. And there's no one-size-fits-all answer for that.
Fair.
So Viola Private Wealth generally deals with wealthier clients, and so I'm interested to know, has the superannuation conversation been different this year compared to previous years because of the proposed super tax change for balances over 3 million?
No, it's really a case of let's see what gets legislated. Sort of, you've still got until the end of next financial year, or the end of this financial year, to sort of position for that. And there's a lot of considerations around if you're going to pull that money out of super, for example, you're pulling out accumulation money, so it's taxed at a maximum of 15%. So there's going to be some tax to pay to get it out, and then you've got to invest it somewhere else. And then the tax implications of doing that, it may not make sense to actually pull it out. So again, it'd be a case-by-case basis.
But in terms of adding more, you haven't pulled back the strategy of concessional contributions or anything like that for those clients?
So bearing in mind that concessional contributions, if your super guarantee payments take up the full $30,000 cap, you don't have the opportunity to do it anyway.
Fair. Yeah,
and if you're over the 500 grand at the start of the financial year, then you don't have the ability to use those previous 5 financial years as well. So a lot of it can kind of be taken out of your hands, but it is the best tax structure that we have. And for those that have significant assets outside of superannuation as well, it can make sense to continue sort of, having those SG payments going in there and seeking to grow that bucket as much as you can.
Yeah.
Well, in our next episode, Peter, we're going to dig into some of the tax structures that we should be thinking about. But just to close out today, is there anything that's better left from a tax perspective until after June 30? Yeah,
it's, I suppose, kicking the gains into the next financial year if you can. Obviously buys you 12 more months without having to pay that money to the
down the road
to the government. Yeah, I suppose it's that sort of Kerry Packer quote from the 90s, whereas tax minimisation is the duty of all Australians. You guys aren't doing a good enough job of spending it that we should be contributing extra. So try and keep it in your pocket for longer.
Yeah, fair call. Well, thank you so much. As we said, in next episode, we're going to be looking at key strategies around right asset, right structure, debt recycling, franking credit recycling, and the like. So we'll be back next episode, but thank you so much.
Thank you.
Well, that'll do us for today, but we're not done talking tax. On Friday, we're back with Peter Nevill, and we're talking about the tax strategies that you can employ throughout the year. Tax is a 12-month journey, as Bryce always says, so tune in to that episode wherever you're watching or listening to this.
A massive thank you goes to Sharesight for supporting our tax series here at Equity Mates. If you would like to get started with Sharesight and make tax time easy, plus tracking all of your investments throughout the year, head to sharesight.com.au/equitymates and you can save 4 months on their premium plan. Highly recommend. But Ren, that does it. We'll be back next episode.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.